Good afternoon, everyone, and welcome to Scotia iTrade's webinars. Today's topic is on advanced option strategies and technical analysis with the market guys. Let's do a quick audio test before we get started. If you can hear me clearly and the sound quality is great on your end, please click on that hand icon in your toolbar. Excellent. Thanks, Heather. Thanks, Charles. Ravi, thank you. And for those of you that are experiencing audio difficulties, you can click on the sound check link or the settings link in your audio panel. The setup window may show up on your secondary screen if you are using two monitors. And as always, everyone is muted for sound quality purposes. And if you do find that the audio quality is not great and you are using your speakers on your computer, you're also welcome to dial in by telephone, and don't forget to enter the access code as well as the PIN number. And just as a reminder that Scotia iTrade does not provide investment or tax advice or recommendations, and nothing in this presentation is or should be construed as investment or tax advice or recommendation to buy, sell, or holding security or to follow any particular investment strategy. Today's presentation, as with all of our presentation, is strictly for educational purposes only. We did get a chance to use this toolbar. I do want to note that in GoToWebinar, the platform, sometimes the control panel may automatically hide. If you want to make it visible or not visible, you can always click on that arrow icon to do so. And also, if you want to view in full screen mode, you can click on the full screen icon as well as the hand icon for any questions. And as always, feel free to type in any questions or comments you may have in the question panel, and our presenter will address them as they come in or at the end of the session. We are recording today's session, and if you did select yes on the registration page, we will email you the recording. Alternatively, you can access our past webinar recordings on our Webinars on Demand page under the Learn and Do More section of scotiaitrade.com. You are also welcome to take notes. However, I will make today's presentation available for you to download at the end of the session. I do want to note that it does show up in the handouts panel as shown here, but the handouts panel is not currently visible and will be so at the end of the session. And our presenter today is AJ Monty. He's a chartered market technician with over 30 years of experience in the financial industry. Currently serves as chief market strategist for the Market Guys, teaching professionals and novices alike innovative techniques to accumulate and protect wealth. He's also one of the more recognized financial experts in the industry, thanks to his appearances on ABC, Fox Business, and PBS television, as well as a regular guest slot on Serious Money Radio. AJ has authored 2 financial education books and is known internationally for his financial educational seminars. Welcome, AJ.
Well, thank you very much, Rose, for that introduction. And just as a note, I am not seeing the slides that you were presenting. I didn't see them advance. So I just wanted to let you know about that. I am going to share my Microsoft application here, which is the Microsoft PowerPoint. Hopefully you could all see this right now as I open this up. Rose, if you could just let me know when you can see that, and I will get the green light from you to begin. Are you seeing that?
I see it.
Okay, great. Now, folks, as Rose mentioned, I have a lot of experience in this area, and I am extremely passionate about this because my goal in life is to help provide value for people, not just in the world of investing and making money, but as a whole, to show people how to improve on their lives, their quality of life. And I ask not just for your attention, but if you could hear my message loud and clear, it would be great. Once you learn these concepts with regard to option trading, I would encourage each and every one of you to go out there and maybe enlighten someone close to you. It might be a family member, a friend, a colleague, and expand their horizons by, I'm not telling you to go teach them how to trade options, but at least pique their curiosity, because this world of options that we are going to be talking about today has literally changed my life in a way that I couldn't even explain in just one short hour. But in brief, I want you to know, I grew up in a blue-collar family. My parents had virtually no money. My father was a landscaper. I mean, he literally pushed a lawnmower to put food on the table for us. And he always told me, don't do what I do. do what I say. And he told me that if you want to be a success in life, you have to surround yourself with successful people. And with his New York Italian accent, he would also say, and if you want to be a bum, hang around the bums. And I took that advice very seriously. And I got the message. I knew that he wanted better for me and his children, and he didn't want us pushing lawnmowers. That was just his way of getting through life. But thankfully, I had parents that cared enough about me to expand my horizon. So what I did is I went down to the trading floor. After I got out of the U.S. military, I went down to Wall Street not knowing anything about investing other than one book that I remember reading. It was called The Elliott Wave. It was the Elliott Wave theory, and I learned how to read charts from starting with that book, and then I started finding other people who were successful, and I did exactly what my father told me, hang around them. And I went down to the World Trade Center, and I found the most successful traders, and I did my best to help them in any way that I could, and eventually I was able to build friendships, and those people, again, in turn, shared very, very valuable information with me. So here I am, 34 years later, sharing that information with you. This slide, I've left it up here, obviously, and very conspicuously, because this is education at the highest levels. And again, this is not information that you're going to learn in any college or university. It is going to be by you plugging in and learning a little at a time at your own schedule, at your own pace, and soaking it in like a sponge. Now this slide here has a website on it, and Rose will be delivering this presentation to you at the very end. If you hang in there, you'll be able to download this as a gift from us to you. And this link will get you to a PDF document that, of course, is written by many of the attorneys in the industry, but it is a very, very good educational piece that you could even get not just in PDF format, but you could order it in hard copy from the exchange and the Option Clearing Corp, and it literally fits in your back pocket. It's a great, great reference tool that you could open up at any page and learn from. And again, I would encourage you to get that and read it at your own pace. So those are the two things I want to give you right off the bat. Now, for those of you who started with us in the basic option concepts, I just wanted to review a couple of things, because if we just jump into the more advanced stuff, I could lose a lot of people, so I think it's good for a refresher. And I'm going to go through these first few slides very, very quickly, just the basic concept of an option contract. It's basically an agreement between two people to make a trade, and those two people agree to make a trade at what's called the strike price. So if you were looking to buy a stock and I was looking to sell a stock, what we do is we agree on the price ahead of time. So let's say we agree on trading that stock between us at $50. It's not a futures contract, but it is a transaction that would take place somewhere in the future. So I don't want to confuse those two things. An option contract is just that. It's a leveraged instrument that will allow you to lock in a trade price, again, that being the strike price, and it is a contract that eventually expires. So each option contract has with it an expiration date. And in this contract, it's the buyer who has full control to force the transaction. The seller has very little control, and I'll get to that a little bit later, but the seller is obligated to the buyer because the buyer is paying you, the seller, money to make the transaction, hence the reason why they're in full control of that. Now, the call option is a piece of paper that gives the owner the right to buy a stock. They don't give them an obligation, because remember I just said the option owner pays money to lock in the price, and they're the ones that, again, going to force the trade. I don't want that to sound negative, but they're in full control. They have the ability to force a trade at any time while they hold this piece of paper. And if the owner decides to make the trade, they're calling the stock away from the current owner, and they become the new owner of the stock. So again, it's very similar to what we've seen already in the world. I've referenced pizza coupons because actually these are option contracts. They're option contracts that you get for free, but in the real world of options, the person who holds the contract has to pay money, and everything is the same. You have the expiration date, you have a purchase price here, which equals the strike price for the pizza, and there were a couple people that laughed at this one because it was so basic, but if you ever want to understand what a call option is, think of a pizza coupon, or think of a real estate contract. And again, I don't know how many of you have bought a home or bought property or sold a home, but before the actual transaction takes place, the buyer and the seller get together and they agree on a price. So they go to contract, that's the term. And the agreed upon price equals the expiration, equals the strike price. So if you are looking to buy a house for $300,000, before you actually buy the house, you lock in the price for, in most cases, 30 days. And at the end of 30 days, that contract expires on the closing date. That's when we close the deal on the real estate. And that's an option contract. Everything about this has the same components as an option contract in the financial markets. And again, if you're ever confused about what a call is, think of the pizza coupon, think of a real estate contract, and you'll be okay. Now, this slide, you might want to take a note to print this one out when you get the PDF document from Rose. And I've never done this before, but I'm going to suggest this to you now, that you put together a little notebook or a cheat sheet and go to one of the office supply places and get one of those plastic page covers. You've seen those, that they usually fit into a 3-ring binder. If you want to make a smaller notebook, then get the smaller plastic sleeves. But this is one you absolutely want to keep in front of you as you're moving from basic options to the more advanced option concepts. Oh, I don't know what happened there.
Sorry,
Okay.
I just want to interrupt you. I don't think we were able to see your PowerPoint in full screen, so we're not sure which slide you're talking about.
Oh, what happened
It's stuck
there?
on the disclaimer right now.
Oh, it should be advancing. I've been advancing the whole time here. Let's see. You're not seeing my slides advance?
No, we just see the PowerPoint, not in full screen mode, but just on the disclaimer slide.
Oh, I'm advancing and it's not moving. Let's see. Show. Let me end the show and see what's happening here. It's telling me it's showing the application. Let me stop show screen and let me show. Rose, if you could, take back control and then give it back to me once again. Let me see what's going on here. All right, now give that back to me and let me try a different mode. Let's see. You still with me?
Yes.
Okay, now I'm going to show my whole works. It's not giving me. Okay, I'm going to try this and see if this works. Is this better?
We see the pizza coupons, not in full screen, but we do see the pizza coupons.
All right, now you tell me if it's changing now.
Okay.
Is it
Perfect.
moving?
Now it is.
I don't know what happened there. Okay. All right, so you heard my voice there, the pizza coupon, the real estate contract. This is the slide that I was referring to with suggesting that you print this one out. And the reason I'm asking you to do that is because the cheat sheet here is a good reference, because what you can do now is you could go ahead and understand the obligation of selling the stock versus the right to buy the stock. Rose, are you seeing my arrows there? My
I
green
do.
arrows? Okay, good. All right, now let's play this out. Let's say that you want to buy or go long a call option. And again, this might seem basic, but I'm going to be building on this like building blocks. When you buy an option, you're going to be spending the cash. So there's a debit in your account. And in doing so, you have the right to buy the option. Now, in this presentation, I'm going to be focusing more on what the obligations are as a seller of the option. Because for over 30 years now, I've made more money selling options than buying them. Now, for those of you who are somewhat versed in options, I'm not talking about selling the option, the call option, and walking away. That's called an uncovered or a naked call option. I would never recommend that. Now, there would be some people that would, but I don't ever recommend people just sell a call and walk away. What I do is I'm going to show you here today how to sell a call, but also how to buy a call for insurance. It's going to be, again, a layered spread trade that is actually hedged and ultimately will limit your risk to a fixed amount. But I love the idea of collecting money to make a promise or obligating myself to make a trade. I love that idea. I mean, immediately you can go into the market, sell an option, and as soon as you hit the trade button, the enter button, and it executes, as soon as that happens, money literally shows up in your account. You get credited immediately. It's like a cash machine. Now, this is going to give you the cheat sheet. So when you sell an option, you're obligating yourself to sell the stock. So another way to think of this is, if you're selling a call, you're basically shorting the market. You want the market to go down. You don't want it to go up. Because if I made a promise to you to sell you stock at $50 and then the stock goes up to 60, well, guess what? I lose $10. I don't want to lose money. I want to make money. So be very mindful of what you're doing here when you sell the option. But another layer that I'm going to build on here for you is I'm going to show you how to use the charts to pick your entry points and exit points. And again, that's something that very few option trainers or educators will do, is show you how to use the technical charts to increase the probability of making money. So far you're enjoying the content, but I promise you it's going to get better here. Now, when I go and I look at the options, let me see, why is this going? I have to get out of that. Okay, pointer. Okay, I have to do it this way. There we go. Now, in the put option, again, just quick review here, it gives the owner of the option the right to also make a trade. So when I buy a put, I'm going to be paying somebody, but my side of the trade is going to be on the sell side. So another way to look at this is, if I buy a put, I have the ability to sell the stock or short the stock even at a fixed price. So again, if I buy a put, it's giving me the obligation, and in this example I'm going to say $50. The strike price is $50. If I buy a put and the strike price is 50, I'm paying money to be able to short the stock at 50. Now, if the stock goes down, let's say to 40, I make $10. And I'm not going to give you all the minute details to confuse you. I'm just giving you the generalities here so that you will feel comfortable in learning the concepts, and then in the end we put it all together. Now, if you have any questions, we are monitoring the Q&A box. Okay, so if anyone has questions, just put it in the question box, and Rose and I will be monitoring that. Okay, so I don't see any questions, so I'm going to move on. All right, now another way to look at the put option is to look at something, again, that you're familiar with. A life insurance policy, an automobile insurance policy, these are put options. What you're doing is you're making an agreement with an insurance company to, in the case of automobile insurance, you're agreeing that they are going to guarantee you a sell price of the car if you crash the car. So let's say something happens and you swerve off the road, you hit a tree, and you're not injured, but your car is totaled and there's no repairing it. Your insurance, acting like a put, allows you to sell the car to the insurance company for whatever the face value of the policy is. Now again, the insurance company is assuming the risk in your automobile, but remember, you're paying them a premium to assume that risk. Same exact thing. When you buy a put, you're paying someone else to guarantee your stock at a certain price. So if the stock crashes, and no pun intended there, but if it crashes and goes lower, let's say it goes from $50 down to zero, the person who sold you the put has to guarantee you the sell price at 50. So you'll recoup all of your money. So in this instance, the put is acting like an insurance policy for the stock. And this is exactly what it looks like in just different words. The sell price is the strike price, which equates to the face value of the insurance policy. Okay, now we're going to start to get into some meat here. So if you have any questions, speak now or forever hold your peace, all right, because we're going to start ramping up. Now, again, this is not basic options, so I might very well make your brain hurt a little bit here, and that's okay. I look at this as I'm a trainer and we're in the gym. I have to make your muscles hurt, right? Well, I'm not doing this intentionally to try to confuse you, but I definitely want to push your limits so that your brain will expand and get this information and soak it in. So like the other screen that I gave you with the calls, I would also encourage you to make a copy of this, and in the process, put it in your book, because I want you to understand what it means to, here we go, I'm starting with selling the put. Now, again, let this soak in. When I sell the put, I become the insurance company, just like the car insurance. So when I sell a put, I am obligating myself to someone else, and I am guaranteeing them, for the money they pay me, I'm guaranteeing them that I will buy their stock if that stock crashes. Now, I want to spend a couple more minutes here, because remember, when you're selling the put, you're collecting a credit. Now, I'm going to flip back and forth from puts to insurance premiums. And think about this. If you were an insurance company and you were insuring someone, you're insuring their property, whether it be a house or a car, do you want them to go give you the money and then go crash the car? Or if you're an insurance company, would you want to take a premium from someone after insuring their home and then all of a sudden they have a barbecue accident and they burn their house down? Of course not. As the insurance company, your goal is to calculate what the odds are based on your driving record or your homeowner's insurance record. Your insurance company will gauge how much money you're going to pay them here. See, the insurance company is going to determine how much you have to pay them based on how much risk they are assuming. So when you sell a put, you don't want the stock to go down and crash. You don't want that stock to go from 50 to 0 and burn to the ground. You don't want that. You want that stock to survive and even thrive, right? Isn't it great if you were an insurance company and every single one of your policyholders were accident-free for their whole lives? What would that mean to you as an insurance company? you'd be rolling in the dough, wouldn't you? You wouldn't have just unbelievable premium amounts coming in each and every month with no payouts. Wouldn't that be the ideal situation of an insurance company? Well, when you sell a put, you better be looking at that chart, because if you're selling a put in a stock that's really sick and it's been going down, 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 you might as well go into the insurance business and sell car insurance to drunk drivers. I mean, it's basically the same thing. When you sell a put, you want to be selling puts in stocks that are looking very healthy, not ones that are looking like they're in a downtrend or in a bear market. So again, make sure that you are going to look at the charts. Make yourself a promise. You're going to look at the charts before you do any transaction in the option markets. Okay, let me advance to the next slide and see what's going here. I'm having a little trouble. I may not use the not use the cursor anymore. Okay, because I'm getting all kinds of error messages here. All right, get here. What's going on with this platform today? That's really, really strange. Okay, I'm going to take that off. All right. Pardon me as I get rid of that arrow. The arrow's not going. Let me go to a pointer and see if that works. There it is. Okay. All right. So, like the option, like the insurance policy, you, the insurance company, you also get to pick how long you want to obligate yourself and how much insurance you want to issue. We don't have to spend a whole lot of time on this one, but you see this chart up here on the top. You see that red candle that all of a sudden the stock fell out of bed? Well, I don't know if any of you were watching Chipotle Mexican Grill, ticker symbol CMG, but CMG did exactly that. CMG dropped about 10% of its value in one day after earnings and set the expectation for lower earnings in the future, and the stock just fell out of bed. Now think about this for a second. Those people who bought the puts were protected because earnings came out, the stock crashed. But because they bought the put, they had insurance. But unfortunately for those who sold the insurance, those people who sold the puts lost a lot of money yesterday. And the stock, I think, is still down a little bit, and it could recover. I think my expectation is that eventually it will recover. But in the meantime, all the people who sold those puts, and that's all they did, just sold puts, lost a lot of money yesterday. So you can see that options do carry a lot of risk. And I don't ever tell anybody that options is safe. In fact, that's why we put all the disclaimers out there, because you have to study this. You have to do your homework. Now, Robert says when you say you sell a call, it's a short, so expect it to go down. Sell a put, you are also expecting to go down. No, that's not correct, Robert. When you sell a call, you're obligating yourself to sell the stock. So you want the stock to go down. If you sell a put, you're obligating yourself to buy the stock at a certain price, and so you don't want the stock to go down. If you sell a put, you want that stock to go up. If you sell the put. Now, I'm putting more emphasis on the sell side, aren't I? And that's what this whole more advanced option trading is about, is understanding what it means to sell an option and what your obligations are versus buying an option and having full control of the transaction. Remember, you are receiving money to perform a trade, and you are held accountable if the stock goes up or down. But in the case of the put, remember, you're obligating yourself to buy. So if you buy the stock, you want it to go up or down. You want it to go up. And that's what it is. So thank you, Robert. I appreciate that question. I'm sure it helped a lot of other people. Now, in the put option, like the call option, each option contract, for the most part, represents 100 shares. So in other words, if you buy or sell one option contract, you're basically controlling a trade that has 100 shares built into it. And then if you're trading a call, same thing. You're controlling 100 shares of the stock. So if you want to buy a put and protect 1,000 shares, you're going to have to buy 10 option contracts if you want to protect 1,000 shares. If you are the insurance company and you are insuring stock and you sell 10 of the puts, then you are obligated to buy 1,000 shares of the stock. Okay, that's enough review. We're now going to start to ramp it up. We're going to go into second and maybe third gear here. I am going to be focusing on OTM, ITM, ATM. In the basic option presentation, I kind of glanced over those acronyms, but today we're going to dig in deep into OTM, ITM, ATM, which really stands for out of the money, in the money, and at the money. If you want to jot that down in your notebook, you can do that and then add it to the slides later. You're more than welcome to do that. Remember, you're getting a copy of the file. And I thought, well, let me strip the option down a little bit by talking about the strike price and only the strike price. So here we go with the option. Actually, oh, let me go back. Let me go and talk about the option strike price and not so much the expiration, the premium. We're not talking about the money. We're not talking about the day it expires. We're only focusing on the strike price. So in this example, let's assume that this stock is trading. I'm going to use my arrow. I'm taking a risk that I have to go back to that later. But let's assume that the stock is now trading $50. I took a nice number that everyone could relate to. There's a lot of stocks that trade for $50. Now, in the calls, remember, if I am buying the option and I buy an option that has a $45 strike price, that is giving me the right to buy the stock at $45, even though it's trading $50. So if I buy a call with a $45 strike, and that's happening while the stock is trading $50, that call has to be worth at least $5. You understand that? So if I have the right to buy the stock at $45 while it's trading $50, I could buy that option at the $45 option, exercise it, and I'll be guaranteed to make $5. Now that might sound a little bit oversimplified. It's not really that easy because, yes, that option has to be worth at least $5, but there's a time component involved in that premium where with each option, depending on the expiration day, each option will have time value added onto what we call the intrinsic value. So again, if the stock is trading $50 and I buy a $45 call, it is in the money by $5. So the $5 represents the intrinsic value. So think of intrinsic being in the money. That's how you're going to remember that. If the option has intrinsic value, then it's in the money. Now, let's go down a little bit. If I buy a $40 call while the stock is trading $50, that has $10 of intrinsic value because I could buy the stock at $40 while it's trading $50. There's $10 built into that. Again, it's in the money. And you can see by following the slides, the lower the strike price you go, the more intrinsic value there is. Now, also keep in mind that the lower you go in strike price, the more money that option is going to cost you. Okay? Now let's flip a little bit. Again, I'm only staying with the calls now. If I buy a $55 call while the stock is trading 50, there is no intrinsic value. I mean, think about it. Stock is trading 50. Why in the world would you want to buy it at 55? And with that example, you might say, why in the world would anyone want to buy a $55 call when the stock is trading 50? Remember that thing called time value? There's a very small amount that you would pay for that $55 call, and you would pay that time value in a speculative move because the stock is trading 50, but you think the stock is going to go to 70. So you spend very little money to buy a call. Now, although it has no intrinsic value, this is called out of the money. Each one of these strike prices for the calls that are above the actual trading price, those are out of the money because they have no intrinsic value, but they do have some value. That's time value. Because, listen, if I was to spend $2 for that call, $2 now, and it goes up to $70 after I buy the call for $2, let's see who's paying attention now. If I buy a $55 call, and then all of a sudden the stock goes up to 70, how much intrinsic value will that option have now? Remember, you have the ability to buy the stock at 55. It's now trading 70. How much intrinsic value is there now? Who wants to be the first one to answer? Paula, you're absolutely right. It has $15 of intrinsic value. I see where you're going with that, Charles. Charles answered $13 because I said that we paid $2 for the option. And I get where you're going with that. But the actual intrinsic value is from 55 to 70, so that's $15. So the option is now worth a minimum of $15, but I only paid $2 for it. So, Charles, you would have a net profit of $13 at that point. Hey, a $13 profit on a $2 investment, I'll take that all day long. So there are many people who buy out of the money calls with no intention of actually buying the stock. They're just buying these calls because they think the value of the call is going to go up. So they trade it like a mini version of the stock itself. And that's why options are such a great tool for leveraging your money, because you really can find options all day long for $2. And in some instances, you can find $2 options on stocks that are trading $400 a share. So it's kind of like levels the playing field. Now, here's what I'm going to do. I'm going to try to confuse you here, but stick with me. Now, let's go to the puts. When I am buying a put, it gives me the ability to sell the stock at a certain price. So if the stock is trading 50 and I have the ability to sell the put at 60, I am looking at $10 of intrinsic value. Now remember, when you're using your cheat sheets, this is another cheat sheet that you can add to the other boxes that I gave you that show the obligations and the cash transactions. So you put those two together and really let this soak in. And I'm telling you, just do it gradually. Don't feel pressure. I can almost guarantee you that as you advance into your world of options and advance in your education, there's going to be many times where you're confused. Many, many times. And it's going to be through the questions that you ask and the books that you read that will help you get through the confusion. It's going to take a lot of repetition to be able to get this down pat. But I promise you, if you remember those days when you were in high school or college and you're sitting in math class trying to understand calculus and you're just not getting it, but then all of a sudden, what happens? You're doing your homework and you get this aha moment. And now all of a sudden you've reached a level of clarity, right? Have all of you reached that point at least one time in your life? That's what's going to happen in options. So remember, if the stock is trading at 40 and you have the 50 rather, if the stock is trading 50 and you have the ability to sell that stock at any price over 50, you're going to be in the money. And remember, when you buy the put, you're giving yourself the right to sell the stock at a higher price. Now, on the other hand, there are people who buy out of the money puts. Think about this for a second. If the stock is trading 50, why in the world would I ever want to sell the stock below 50, especially at $40? If I exercise that option, I would immediately lose $10, right? Stock is trading 50, I go and sell it for 40, I'd be a lunatic to do that. But if I bought that $40 put and the stock dropped to 30, let me tell you, I'll make $10. Even if I only pay $1 or $2 for that option, it doesn't matter. As the price of the stock drops, these puts increase in value. Okay, now let's go ahead and try to ramp this up. Okay, I'm going to ramp it up, and I'm going to try to get this to a place where you're all, oh, there we go again. There we go. Trying to get rid of that arrow. Oh boy. Rose, I promise I'll practice this next time. I don't know. This is the first time we've had that problem, but I don't know what's happening. Let me try to get that out of there again. All right. Huh. It's stuck. All right, let's see if I could put this here, pointer, and there we go. All right, now we're going to take, remember I said about building blocks, right? We're going to take everything that we've discussed so far, and in the next 18 minutes, I'm going to try my best to bring it all home for you. Now, spread trading, in my opinion now, this is my personal opinion, don't take this as advice or a trade recommendation. Remember, this is my opinion. I believe spread trading is the best way to go if you want to trade options. I see more people losing money trading options by just buying the calls and buying the puts, not knowing what they're doing with the charts, and it's more like a casino for a lot of people. But when you learn how to spread trade, you're dramatically increasing the probability of making money, while at the same time limiting risk. See, that's the whole point about spread trading. If you learn how to cap your losses while looking at the charts, and again, using the charts to gauge the future price expectation, you'll make a lot of money. And back in 1982, remember, that's when I first came onto the trading floor. In 1982, they didn't trade options at that point. It wasn't until 1985 that they started trading options on the New York exchanges, in the commodity exchange in the World Trade Center. But I had from 1982 to 1985 to learn chart analysis. So I dug into technical analysis during that period of time, and I became an expert. In 3 years, I became an expert chart reader. And then what I did is I learned how to trade spreads, even at the most basic level. And from 1985, or I should say in 1985, I took $2,000 of my own money, which was, it's not a lot of money now, but back then, you know, it was a lot of money for me. $2,000, and I don't come from money. Remember, I told you my life story there. But I took $2,000, and by 1988, I had turned that into $1 million. 2,000 to 1 million trading spreads. And this is just one of the many different spreads that you can trade. We will not have time to get into diagonal spreads. Rose, maybe we can put together a much more advanced level of trading where I'll get into diagonal calendar spreads. But this is a great way to get started in spread trading, and this is called a vertical credit call spread. That's what this is called. Now, look at the green arrow. I'm not going to take a chance of putting the other arrow on there and locking the screen. But look at the green arrow. Rose, can you see my cursor kind of rolling around in the 60? Can you see that? Oh, good. I'll just use that then. Okay. So the green arrow is green because I'm selling the call. This is the spread trade. The stock is trading 50. Remember that. The stock is trading 50, and I am selling the call. And the reason the arrow is green is because when I sell that call, I'm going to be collecting money in doing so. Now, whatever that price is, let's say I sell that call for, let's say I sell it for $3. I sell that one for $3, and what do I want the stock to do? If that was the only thing I was doing, I want the stock to stay below 65. That's my goal. If I sell a call, now again, you're going to have to go back to your sheet. Remember what the obligation is when you sell a call. If I sell a $65 call, do I have an obligation or do I have a right to make a trade? Who wants to be the first one? If I sell a call, do I have an obligation or do I have a right to make a trade? I know there's a little bit of a delay. Wow, Paul, you're fast. Absolutely. You have an obligation to sell the stock at 65. Now, you will not sell that stock at 65 until the price starts moving up and over 65. So as long as it stays below 65, you're good. You get to keep the money. So let's say I sell that one for, what did I say, $3? We sell that one for $3. And then what I'm going to do in the spread trade is I'm going to take some of that money. In fact, I'm going to take 2 of the $3, and I am going to buy a call here. See, now, here we go. Opposite of the obligation is what? When I buy a call, I now have the right to buy the stock at 70. So if I sell this one for $3 and I spend 2 of those $3 on this call, then I get a net credit of $1. I get a net credit. And as long as the stock stays below 65, it could go to $64.99 and I'm still going to keep my dollar. And in doing so, as long as it stays below 65, I get to keep the money. Isn't that great? So that's a pretty big window for profit. Now, when you're doing this, you absolutely want to make sure that the charts coincide with your strategy. So this is an actual chart. This is how you look at it. And so this is where your technical analysis skills are going to play and weigh in heavily, because if the stock, you can obviously see the stock is bumping its head up against the $60 resistance area. You also see that the stock has been pulling down from that resistance. You also see that the stock's price is going down below the moving average. If you don't know what I just said, plug into a technical analysis class that I do, or you can go to the videos on my webpage. It teaches about this. And if the signals on the chart are showing bearish and you see resistance at 60, then guess what? I'm going to sell a $65 call, buy a $70 call, keep the dollar, and I could relax. Again, I can relax as long as it stays below 65, and I could relax even more as long as the stock is staying below the moving averages and below resistance. Now again, this is where we're putting chart analysis together with option trading. This is where you're going to get the highest probability. Now, if you're not using charts and you're just selling call spreads like I just mentioned, there is going to be a lot more risk. A lot more risk. Because remember, if the stock has been trending higher and I'm selling calls, I'm almost guaranteed to lose money. Now, this is how it looks on paper so you can see what the return on investment is. Remember, I'm selling the $65 calls, but I'm buying the $70 calls. Now, for most of you, you're not going to be able to just do this tomorrow. You have to get with your relationship manager at Scotia, open up a basic option account, and you're going to have to answer some questions, and they're going to make sure that you know at least how to manage some risk. They're going to ask you what your risk points are. So again, this is the first step for many of you, but you're not going to be able to just do this tomorrow until you prove yourself to your broker that you can handle the risk. So I'm going to show you what the risk is. When I sell a $65 call, I'm obligating myself to do what? Sell the stock at 65. And if I buy a $70 call, it gives me the right to buy the stock at 70. So let's look at worst case scenario. The worst case scenario is the stock goes over 70 and stays there. And what happens in the end is I will have to sell the stock at 65 and I'll buy it at 70. So I'm going to lose $5 here on this transaction. Again, if the stock goes over 70, that's the most I could lose is $5. But remember, I collected $1 when I first sold the spread. So my max loss is $4. Now, for every option contract, that works out to be about $400. So if you sold one option contract like this, a $5 spread as they call it, if you sold a $5 vertical call spread, or if you sold a $5 credit spread and you collect $1, the most you could lose on that is $400. Remember, 4 times 100 shares. So in the margin account, your broker is going to ask you to lay out the maximum loss first. See, they're going to ask you to lay out the $500 per contract because that's the most you could lose up here. And then after they ask you to lay out the $500 and you do the trade, you then collect $100 on your $500 investment. So that works out to be a 20% return. Now I'm going to show you at the very end. I got to monitor the time here because I'm running out of it very quickly. I have 9 minutes. This is going to be an example of the puts. Now I'm going to breeze through this. I'm not going to stress the put spread so much because, again, my personal opinion thinks we're going to pull back quite dramatically in the market. So I don't want to see people going out there and just selling a bunch of put spreads because you could get hurt in a major pullback. But the same concept is I'm selling options. I'm selling an option that has more in the money value than this one. So the net transaction is going to be a credit to my account. Again, these are the puts. Stock is trading 50. I'm selling a put at 35 strike. So if the stock is selling at 50 and I'm selling a put, I'm obligating myself to buy the stock at 35. Now, while the stock is trading at 50, I have no problem with that. But if the stock goes from 50 to 20, I now have a problem with that. If it's trading $20, I still have to obligate myself to buy it at 35. So if I did nothing else, I could lose $15 on that. But what I do is I take some of the money and I apply that to long puts, which is now I'm taking some of my money and I'm buying insurance for myself. So the most I could lose here is $5 less what I collected on the spread. And the only time I would do this is if the stock is bouncing off of support. The exact opposite of what we saw in the call example. I want the stock to be going up if I'm selling a put spread. You see that? So this is really where the rubber starts to hit the road, and this is how the equation looks. And believe me, when you get these slides, you can let this soak in. You could ask questions at the next event. You know, I'm here. We have a relationship with Scotia, so if you have questions that are carrying over to the next event from this event, write your questions down. You might even say in the Q&A box, hey, Paula might say, hey, AJ, you know, I saw that calculation you did last event. Can you elaborate on that? Of course I'm going to do that. Absolutely. Remember, this is only an hour class. I can go on for days and days teaching you options and all the ins and outs of it. But this, again, is knowing how to manage risk is going to be the most important part. So if I'm collecting $1 and the most I'm risking is $5, my net risk is $4. But if the stock stays over 35, I get to keep the dollar. On a $500 margin requirement, that works out to be 20% return. And you know, again, I use the chessboard because it's like chess. You have to know how each one of the pieces move. In this class today, I talked about how the puts move. I talked about how the calls moved. I talked about how some are in the money, some are out of the money. I talked about how some are more in the money or more out of the money than the other. And knowing how to put them all together is how it works. Now, I decided last minute to throw in an actual trade. Now, I do trade recommendations for our subscribers. This is an actual trade alert. Notice the date, July 29th. This is the actual chart that I printed on that day in July 29th. And look at what the stock was doing. This was Google. If you notice, the stock was hitting resistance up here. I'll zoom in a little bit more on the next slide so you can see. But the stock was hitting resistance, and I was talking about a theory called the rubber band theory. There was a high probability the stock was going to pull back based on its historic pullback points. Well, guess what? That's exactly what happened. Now, on July 29th, I sent out this alert to our subscribers to sell a call spread. In this example, notice the difference in strike. It's not a $5 difference, it's a $10 difference. But the same concept. Look, we sold the 820s, which are the higher priced option, and with some of that money bought the 830s. And the net credit that we took in was $1. Well, look what happened. This is the actual chart. This is a weekly chart from today. This is today's chart from today based on Google's performance on a weekly scale. So this arrow shows the date the alert went out. And remember what I said. The expectation was that the stock was going to pull back from the dotted line, which was resistance. Remember, this is a weekly chart. In the report, I put the daily chart. Well, on the green arrow, that's when the options expiration took place. That was expiration for the September option series. So, and this is exactly what we did in the alert. We sold the 820s, we bought the 830s, we kept the dollar. Now, my margin requirement was $1,000, which here is the difference between the two strikes. Remember, your broker is going to require a margin account for this so that you deposit money that represents the maximum risk. So you put up the $1,000, immediately collect $100 on that $1,000 investment, and as long as the stock stays below 820, which it did, you'll realize the profits. Now, in this actual example, we had a return of 10% in 49 days. I'm not even going to try to impress you by annualizing that. 10% in 49 days is incredible. Now, also know you're not going to be putting all of your money into one option trade. So this isn't any kind of an income claim where I'm saying you're going to get 10% back on your whole trading account. This is 10% return on the money that I invested in that particular trade. And as you go along and you increase your skills or improve on your skills for technical analysis, this 10%, 10% here, 10% there, 10% the next day, next month, over time, it works out. And it's a very, very impressive way to get started in option spread trading. Now, tomorrow, I'm putting out an actual trade alert to our subscribers. I'm not even going to ask you to put your I'm not going to ask you to put your email address in here. Don't do that. Don't put it in. If you want to get a sample of this actual live alert for tomorrow and tomorrow only, I'll email that to you, but you're going to be removed the following week, just so you understand. I'm basically going to be looking and shopping for a credit call spread for our subscribers tomorrow. And the reason I'm doing it on Friday is because it'll give our subscribers a whole weekend to actually study it, understand it, and then actually execute it on Monday morning. So I'm putting the trade alert out tomorrow to set it up for the opening on Monday. So there's no risk for you whatsoever. And again, if you're not an option trader, you're not going to be able to trade it anyway. So there's no risk, but use it as an educational resource so that you can really get this and absorb it. Like I said, I'm very passionate about this. I love what I do. I love teaching people. Pass it on, share it, and by all means, stick with Scotia because they're providing you with really, really valuable information and education. So you don't have to pay me for this. Scotia pays me to do this for you. And that's the relationship that you have to thank them for. It's really great. And Rose, thank you so much for dealing with some of my fumbles here on the PowerPoint, but we'll get it nailed down next time. Back to you.
Not a problem, AJ. Thank you. So let me just share my screen with you. And okay, great. So next steps, you can access our webinar recordings on our website. And don't forget to submit or fill out the survey that shows up after you exit today's session. And also, you may have noticed that the handouts is now available on your control panel, so please download that file freely. And also mark your calendars. On Tuesday, November 1st, we have our How to Get Started with Scotia iTrade webinar at 1 p.m. Eastern Time. And AJ joins us again on Thursday, November 10th at 1 p.m. Eastern Time to present on 10 most frequent mistakes traders and investors make. And also do feel free to sign up for our other webinars on our seminar and webinar calendar under the Learn and Do More section, as well as past recordings, again, can be accessed on our webinars on demand page. And with that, I want to thank AJ for sharing his insights, and thank you all for joining us today. And I will just check the question panel just to see if there are any other questions for AJ. No, really, it's just all about the options Oracle, AJ, and I think you see all of those messages there as well. So thanks, everyone, and have a great day.